Hello everyone, I am Dilber ÖZ and today I will talk about skill-based technological change and income inequality from International Economic Book. So let's start. Firstly, the high-tech sector is more skill-intensive than the low-tech sector, and so the HH curve is shifted out relative to the LL curve. In panel A shows the case where increased trade with developing countries leads to a higher skilled-unskilled wage ratio. Producers in both sectors respond by decreasing the relative employment of skilled workers. You can see they are both decreased. And panel B shows the case where skill-based technological change leads to a higher skill-unskilled wage ratio. The LL and HH curves shifted out and increased relative demand for skilled workers in both sectors. However, in this case, producers in both sectors respond by increasing their relative employment of skilled workers. You can see they are both increased. So in this page, in panel A, we can see the case where increased trade with developing countries generates an increase in wage inequality in those countries. And when I say wage inequality here, I mean skilled and unskilled wage inequality. In addition, the increase in the relative cost of skilled workers encourages producers in both sectors to reduce their employment of skilled workers relative to unskilled workers. And in panel B, we can see the case where technological change in both sectors generates an increase in wage inequality. And this technology change is classified as skill-based because it shifts the relative demand for skilled workers in both industries. As you can see, both the LL and HH curves shift, and it also results in greater productivity gains in the high technological sector due to its complementarity with skilled workers. Thus, for any given relative price of high technological goods, technology change is associated with a higher rate of skilled and unskilled wage. And as you can see, the SS curve shifts. Auto-skilled labor is relatively more expensive. Manufacturers in both sectors respond to technological change by increasing their employment of skilled workers compared to unskilled workers. And we will now look at changes in the skilled to unskilled employment ratio in US industries and examine the merits of trade versus skill-based explanations of technological change for the rise in wage inequality. This widespread increase in employment rates for all different types of sectors in the US economy, and both skilled labor-intensive and unskilled labor-intensive sectors, indicates the skill-based technological explanation. This is what has been observed in the United States over the past half-century. With a few exceptions, non-production positions require higher levels of education. And so we measure the skilled-unskilled employment ratio in a sector as the ratio of non-production employment to production employment. Sectors with the highest non-production to production employment ratios are classified as most skill-intensive, and each quadrant of the graphic shows the evolution of this employment ratio over time for each group of sectors, and our average employment ratio across all sectors in the group. And although there are big differences in average skill intensity across the groups, we clearly see that the employment ratios are increasing over time for all four groups. And the widespread increase in most sectors of the US economy is indeed one of the main pieces of evidence pointing to the technology explanation for increases in US wage inequality. While most economists agree that skill-based technological change is occurring, recent research has uncovered some new ways in which trade has accelerated this process of technological change, indirectly contributing to the society's increases in wage inequality. These explanations are based on the principle that firms have a choice of a production method influenced by trade openness and foreign investment. For example, some studies show that firms that begin to export also upgrade to more skill-intensive production technologies. So another example concerns outsourcing and liberalization of trade and foreign investment. In particular, the NAFTA agreement between the United States, Canada, and Mexico has made it significantly easier for firms to move different parts of their production process to different locations in North America, such as research and development, component production, assembly, or marketing. Because production worker rates are significantly lower in Mexico, US firms have an incentive to move processes that use more production workers to Mexico, and processes that rely more heavily on higher skilled non-production workers, such as research and development and marketing, tend to stay in the United States or Canada. And from a use perspective, the fragmentation of the production process increases the relative demand for skilled workers and is very similar to skill-based technological change. And one study reveals that this outsourcing process from the United States to Mexico can explain 21 to 27% of the increase in the wage premium among non-production and production workers. Thus, some of the observed skill-based technological change and its impact on growing wage inequality can be traced back to increased openness to trade and foreign investment. And let's not forget that the increases in wage inequality in advanced economies are a real concern. However, the use of trade restrictions aimed at limiting technological innovation is particularly problematic because these innovations favor relatively higher skilled workers. And these innovations also bring substantial overall gains alongside the standards gains from trading. So, in summary, economists favor longer-term policies that facilitate the skill acquisition process for all workers so that the gains from technological innovation can be spread as widely as possible. So in the previous, we talked about the difference in wage rates for American workers over the past half century. In this period, there were compensation gains for skilled workers, but in the same time period, the compensation of capital owners also increased. We measured this by looking at the share of total income that goes to labor compensation. That is, the remainder of total income is returns on capital like compensation. If we look at the adjacent graph, this shows how the labor income share for American workers fell from 65% in 1975 to 60% in 2012. In other words, returns to owners rose from 35% to 40%. One possible explanation for this trend is that increased trade with labor abundant newly industrialized economies, just as with increased compensation for skilled workers, will encourage a move toward equalization of factor and price for compensation for capital and labor. Compensation of capital will increase for the capital abundant United States and decrease for the labor-rich NIEs. Once again, the evidence strongly contradicts this prediction. The chart also shows the average world trend for labor share based on a large sample of 59 countries. And the trend towards lower labor income shares and higher capital shares is a worldwide phenomenon, as is the case in labor abundant countries and capital abundant countries around the world. And thus, once again, the evidence supports an explanation based on technological change within sectors, returns on capital also occurring predominantly within sectors. The way to model such technological change is to introduce a three-factor production function in which capital is substituted for unskilled rather than skilled labor, skilled and unskilled labor, and capital. This is called capital skill complementarity because the love substitution between skilled workers and capital makes these factors complementary in production. Technological change takes the form of new and better machines that displace unskilled workers but still require skilled workers. This results in higher returns for both capital and skilled workers, while reducing returns for unskilled workers. Such technological change, automation, may explain the observed worldwide increase in both wage inequality and return on capital, as well as intra-industry increases in the employment share of relatively skilled non-production workers. So that's all I'm going to tell you, and I hope you enjoyed it. Thanks for listening.